In the original Ichimoku videos, I focused on Forex on the higher time frames. Two of the more common questions in the comments were, does it work on crypto and what about the lower time frames? In this video, we're going to answer both. I backtested Bitcoin on the 15-minute, the 1 hour, and the 4 hour. I started on January 1st, 2024 and logged hundreds of trades. In this video, I'm going to share the results with you. If you're not familiar with the bounce method, I'll leave a link in the description below. For this strategy, we only need two indicators. Search for Ichimoku, and the one we're going to use is called CM Enhanced. And the other one is just the standard ATR. I keep all the Ichimoku settings on default. 9, 26, 52, 52, 26. Same for the ATR, I keep it on 14. I've gone over this in previous videos, but for the bounce trade short, the previous candle needs to close below the cloud but above the TK, which is the faster moving average. So the previous candle is in the crosshair. The yellow is the TK. We see the yellow is at 66,973, and then this candle closed at 66,976. So it closed above the yellow moving average. We also see the previous candle closed below the green cloud. In order to take a short, we need the future cloud to be red. We need the price to close below the green cloud, below the slower moving average, the KJ, below the faster moving average, which is the TK, and then moving back to the purple, which is the lagging span. We see it's below that candle. Everything lines up, so now we're ready to take a short. This is where the ATR comes in. We see we have a current value of 198.29, and this is what we use as a stop loss. Since the ATR is 198 and our stop is 198, this would be a stop of 1 ATR. But we're not restricted to only using one ATR. So for example, if we wanted to use a stop 2 ATR, our stop would be about $400. And if we wanted to use a stop of 0.5, we'd use a stop of about 100. Later on in the video, we'll go over the difference and show you what's the best stop to use. With the bounce trade, we don't use a fixed take profit. We only close a trade when it closes above one of the moving averages. We can either use TK, the faster moving average, or KJ, the slower moving average, as the trailing stop loss. So this very next candle, the TK is at 935, we close at 934. So we're still below and we're still in the trade. So remember, it's a close above, not a wick above. So both of these candles, we would not exit the trade. We close below the yellow and we close below the blue, so we would still be in the trade for both. So for the yellow, it's 778. We closed at 786. So we closed above if we're using TK. This is where we would get out of the trade. If we're using KJ, the slower moving average, we're at 974. So we're still below that moving average. Looking at the blue moving average, we're at 355. We close at 353. It's close, but we're still below, so we would not exit the trade. The blue moving average is at 311. We closed at 350. We closed above, so we would exit at the very open of the next candle. Using KJ, we see we have an R to R of about 2.9 to 1. If we got out with TK, the faster moving average, we'd have an R to R of about 0.7 on this trade. And of course, with a tighter stop loss, our R to R goes up. So here we're at about a 0.5 R, or $100 stop loss. R to R goes up about 1.38, and then up to 5.74. It's a higher reward, but it's also higher risk. Towards the end of the video, we'll talk about how to balance that out and what's the best ratio. Here we get a nice move down. Let's see if this was a bounce trade. A few things wrong here. The previous candle was above the TK, which is good, but it's also above the cloud. So this would automatically disqualify the trade. Not to mention the future cloud is green, which we can't have for a short. It closed above the cloud, which we can't have. And then the lagging is above the candle. So all of this would not make it a bounce trade. How about this? Would this be a bounce trade? No, this would not be a bounce trade either. The previous candle has to close above the faster moving average. Here it actually closed below. Not to mention the future cloud is still green. If even one of these does not match up, there's no trade. I've gone over a lot of examples in previous videos, but just to recap, for a long bounce trade, we need a few things. The previous candle needs to close below the TK, the faster moving average, but above the current cloud. The current candle needs to have a future green cloud. It has to close above the TK, KJ, and the current cloud, and then the lagging must be above. Here, this would be a valid bounce trade. Previous candle closed below the yellow, but above the cloud. Future cloud is green. The current candle, let's say it just closed, so it's above both moving averages and the current cloud, and the purple lagging is above the candle. If we're going to use an ATR of 1, our stop loss would be $272.66. We don't exit until the full stop loss is hit or it closes below one of the moving averages. Here the yellow is at 547, we closed at 487, so we closed below. If we're using TK, we would get out at the open of the next candle. If we're using the blue KJ slower moving average, is at 731. We close at 737, we're still above, so we're still in the trade. And here we close below. We close at 746, the blue is at 791, so we would exit at the open of the next candle. Using a stop of 1 ATR in the faster moving average, we'd make 0.85R. And if we use KJ, the slower moving average, our profit would be 1.82R. Let's start to look at some results. I backtested Bitcoin starting on January 1st, 2024. On the 15-minute time frame, I took 281 trades. As I mentioned before, you have two decisions to make when taking a trade. Do you want to trail your stop with TK, the faster moving average, or do you want to use KJ, the slower moving average? We're using ATR as the initial stop loss, and you can use whatever multiple of it that you want. Here I show you the results for both TK and KJ using an initial stop of 0.5 all the way up to 4 times the ATR. 0.5 KJ is throwing off the scaling, so let's not use that to get a better picture. I want to mention two things here. One is obvious, the other is more subtle. TK, the slower moving average, is in red and KJ is in gold. For almost every multiple of ATR across the board, KJ is higher than TK on the 15-minute chart. For example, at an ATR of 1, TK has a profit of about 11 and KJ is up to about 16. At 1.5 ATR, TK drops to about 9 and KJ is up to about 19. The other thing to note is how much profit can change when you cap the max profit per trade. Let's focus on the few bars in blue now. As we saw before, a smaller stop loss in the same trade will increase the R to R profit. This will have the biggest impact on the tiny stop losses. It's great when it works out, but we don't want to rely on a few massive winners to account for the majority of our profits. The variance would be too high. It's great for backtesting, but think about it in the real world. If you take a few losses and you're away from the computer when one of these great trades happen, your expected results will not really match up to your actual profit. Over the almost 300 trades on the 15-minute, we see a handful of these accounted for the vast majority of the results. Let's take a look at what would happen if these massive winners were only 10R trades in the future. TK 0.5, before it looked like a decent system with a profit of about 12R. We're not deleting the 20R trades, we're only capping them at 10R. Even with the small change to only a few trades, we see the profit plummet. In over 300 trades, 0.5 TK actually loses almost 15R under these conditions. 0.6 TK goes all the way from 23R down to 7R, and 0.7 TK goes from a winner to a loser. I'm always happy to read comments of viewers telling me they not only watch my videos, but they're also putting what I teach into practice and making money. Here are 3 common comments. He took a trade yesterday and made 15K. Someone else has been on a winning streak of 75%, and somebody else took a short and made money. I always try to keep these people grounded. I tell them I'm happy for them, but Ichimoku isn't a magical system. You'll have plenty of losses with it, so more than anything, make sure you're not risking more than 1 or 2% on any given trade. I know the numbers, and a win rate of 75% is actually much higher than expected. Some people have early success, they take a few losses, and then they want to throw the baby out with the bathwater. They look for the new shiny system to try out. Let's take a look at the actual stats for the 15-minute time frame. For a stop of 1.5 ATR with TK, the faster moving average, we expect to lose half the trades. I define break-even anywhere from a loss of a negative 0.25R up to a win of 0.25R. This happens about 30% of the time. You should only expect a full win a little more than 20% of the time with TK. KJ, the slower moving average, is more of an all or nothing system. Instead of losing 50%, this goes up to 60%. We have less break-evens at 15%, but we do win about a quarter of our trades. Now, you might be thinking to yourself, how can the balanced trade system be winning if we lose 50 to 60% of the time? You have to realize that the win rate is only half the story. It's just as important to know how much you win when you're right and how much you lose when you're wrong. A lot of the time, we're not going to be taking a full loss. Here we have a valid short. ATR is about $300 and we want to use a multiple of 1.5. So this would give us a stop loss of about $450. If we're using TK, the faster moving average, this is where we would have gotten stopped out. Here we only took a $95 loss instead of the $450 that we planned on taking. So instead of taking the full negative 1R loss, we only had a negative 0.2R loss. And if we're using KJ, the slower moving average, this is where we would get out. The loss with KJ is negative $246.50, which is a negative 0.55R trade. With 1.5 TK, our losses averaged negative 0.57 and our wins were 1.6 for an R to R of about 2.8 to 1. With 1.5 KJ, average loss is 0.77 and average win goes up to 2.29 instead of 1.6 for an almost 3 to 1 R to R overall. Let's take a peek at how the system performed on the 1 hour and 4 hour, and then we'll summarize the best settings for each. As a reminder, I took almost 100 trades on the 1 hour, but obviously the 4 hour trades happen a lot less often, so don't put too much weight on those results. If you recall from the 15-minute, the slower KJ performed much better. The 1 hour is actually the opposite. KJ gives too much profit back on the 1 hour and was frequently negative. On the other hand, TK was positive across all stop losses. It may be tempting to set your stop at 1.1 ATR, since this is the highest value, but I'd be careful about over-optimizing your system. If it were me, I'd drop down the curve a bit and would favor a stop of 1.2, 1.3, or 1.4 on the 1 hour time frame. Going from the 15-minute to the 1 hour, we have the same winning percentage at 24, but notice a few key differences. Losses go down from 60 to 55%, and even more important, we go from a 3 to 1 all the way up to a 7 to 1 R to R. Moving up to the 4 hour time frame, TK did well, but KJ did even better. On the 15-minute, we want a stop loss around 1.4 ATR, but the 4 hour already has a large ATR, so we choose a stop around 0.6x the ATR. To recap, on the 15-minute, I look to use a slower KJ with a stop of about 1.4x the ATR. If you trade Bitcoin on the 1 hour, I'd focus on using the faster TK and my initial stop would be 1.2 or 1.3x the ATR. If you swing trade Bitcoin in the 4 hour, I'd go back to using KJ, the slower moving average with a tighter stop loss, about 0.6 ATR. Now it's time for a pop quiz. We're gonna go over a few charts. Pause the video each time and ask yourself what you do. Here we have a valid bounce trade. It's 10:30 in the morning, but you're away from the chart when it happens. You come back around lunchtime and still have conviction in the trade. Should you take it or let it pass by? It's your own money and you can do whatever you want with it. But if we're talking just about the rules of the system, the bounce trade is only valid on the very next candle. You would go short at the open of this candle. If you missed it, don't worry about it. Trading isn't going anywhere and there'll be plenty more opportunities in the future. Let's say you did decide to wait. Here we closed above the faster moving average. If we get a close back below, then we can take a short. We're on the 15-minute. We need to set our stop loss. Our choices are 0.5 ATR, 1 ATR, 1.5 ATR, or 2 ATR. Which stop loss do you want to use? The number we talked about before was 1.4 ATR for the 15-minute time frame. 1.5 is the closest. There's no one perfect number, so you can use 1.4 or 1.5. So we see we have an ATR of 183.54. How much would your initial stop loss be? Initial stop should be somewhere in the range of 257 to 275. And the last thing we have to decide is how we're going to trail our stop loss. Are we going to use TK, which is the faster moving average, or KJ, which is the slower moving average? For the 15-minute, we want to use KJ, which is the blue slower moving average. So at one point during this candle, we were actually above KJ. At that time, would you close out your trade? No, we're not concerned about the wicks. We're only concerned where it closes. Since it closed below the moving average, we're still in the trade. Here, the moving average is at 311. We closed at 350. We closed above. So now would we get out? Yes, this would be our exit signal. We'd make 1.5R. We're still on the 15-minute, we get a valid bounce setup and we do decide to take the trade. We're still in the trade, but we get another valid bounce setup. This previous candle was below the faster moving average, now we bounce up, it's above, so this would be another valid bounce setup. The question is, should we enter in a second position? I may have several trades running at the same time, but that's across multiple instruments. I typically only run one trade per chart. If a few candles ago I got stopped out and now I get another setup, I'd be happy to take it again. But if I'm already in profit, I'll just let this trade play out. How about this? Is it a valid bounce setup? If you look at the candle before, it actually closed inside of the candle. This would invalidate it. In order to have a short bounce setup, the previous candle already had to close below the cloud. Take a look at this. Is this something you would go long on? The faster moving average, the yellow, is below the blue, so this would not be a bounce trade. Another possible bounce trade. Do you see anything wrong here? The future cloud is red. We need it green, so we would not take this trade. Now we're on the 1-hour chart. Would we use the faster or the slower moving average to trail the stop? The 15-minute we use KJ, but on the 1-hour we're going to use TK, which is the faster moving average. And then what are we going to use for the initial stop? We can use a 1 ATR, 1.25, 1.5, or 1.75 ATR. The answer is 1.25. Look at this chart. There's one or more valid bounce trades. Tell me where you would enter and where you would exit. First trade is up here. We close below the faster moving average and we go short at the open of the next candle. We eventually close above the faster moving average, and this is where we would get out. A few candles later, we get another chance to get back into the trade. We go short, and then this is where we would get out. Tell me what your initial stop loss would be. On this candle, the ATR is 280. And then the second candle, our ATR is now at 334. First candle, the ATR was 280. We use a 1.25 multiplier, so our stop loss would be $350. We'd eventually get out for about a 2-to-1. Next entry with an ATR 334, our stop loss is 418, and eventually we got out for a little over 1-to-1. We have a nice uptrend and we have another chance to get back into the trade. ATR is 336, so our stop is 421. A few candles later, we've closed below the faster moving average, but we haven't hit the full stop loss yet. What do we do? On the 1 hour, the faster moving average is our trailing stop, so you would exit now for about a negative 0.5R loss. We get a short trade on the 15 minute. ATR is 176, so our stop loss is 247. We hit the stop loss, but we're still below the blue moving average for the trailing stop. So should we get out or should we wait until we close above the blue? Your stop loss should be set as a market stop. As soon as price hits the line, your market order should have been filled. You'd already be out of the trade. The thing I tell losing or break-even traders is you want to find a mechanical system and stick to the rules. The true beauty of the bounce trade is the rules are black and white. If everything lines up, you take the trade and you don't exit until you close past the moving average. There are two main reasons people struggle with it. The win rate is less than 50%. If you take a couple losses right off the bat, would you get discouraged and strategy hop to the next idea? Or let's say you take 2 losses in a row, but now you're in a profitable trade. You can close the trade for 3R and wipe out your losses, or you can let the trade play out. You might lose your open profit, or you might make even more. Ichimoku is a trend following system. I can tell you it's profitable, but only if you let your winners run. If you have any questions, let me know in the comments below. Click here to watch the original bounce video, or click here to learn how to use the higher time frame to filter out more bad trades. Thanks for watching. Talk to you soon.